Yeah. So after all this, one thing this is left in this chapter is transitional provisions. So what is transitional provisions? Basically, they are trying to say that if globe applies from this year, this current year. In UAE, it is applicable only from 2025. So what about the previous DTA and DTL balances? Okay, we will be carrying forward some DTA and DTL balances from 24, right? What about them? So there are few transitional provisions also. All this is regarding DTAs and DTLs. What will happen from 25 and onwards, right? What about the opening balances? So there are few transitional provisions which we have to understand. So what would be the transitional provisions? What adjustment should we make on the initial one is what we will be discussing now. Okay, so we'll go one by one. So transitional deferred tax adjustments. When an M&E group enters the globe regime for the first time, its constituent entities carry existing deferred tax balances that may require alignment. In Article 9.1 establishes how pre-existing balances are brought to the system. You understand this is not chapter 4, this is chapter 9. So thought of including it here because you could understand instead of going at 9, forgetting all what we discussed in chapter 4, it would be very difficult. So we are bringing it here. Okay. Right. So what are the transitional deferred tax? First thing is opening balance recognition. So what does it mean? At the start of the transition year, existing DTAs and DTLs must be identified and restated for global purposes. Okay. So we'll understand what does mean by identification and restatement. What are the step-by-step processes? You have to extract all DTAs and DTLs from the opening balance sheet. Okay. Then restate each balance at lower of 15% or applicable domestic rate. First thing you have to do is restate it to 15% or the applicable domestic. Okay, this is kind of thing. Yes, opening also you have to restate. This is the first thing that you will do. Then exclude DTA details relating to excluded gold income. Yes, this is a different chapter, guys. I thought of keeping it here so that you could understand. Exclude DTA details relating to items excluded from globe income. Apply loss DTA recasting wherever apply. What is loss DTA recasting? What is loss DTA recasting? If there is any loss which results in a DTA and that DTA is at a rate lower than 15%, then you can recast upward. Okay. So all those step 1 to 4 we have to do on the opening balance as well. And step 5, record restated balances as opening globe deferred tax position. Did you understand step 1 to 5? Once you extract all the opening balances, restate it to 15%. If the rate that is used to capture these DTAs and DTLs is 30 or 40 or any rate which is more than 15, then you have to restate it to 15% or the applicable domestic rate, 9%, whichever is lower. Okay, if it is 9 per the DTAs and DTLs in UAE are recognized based on 9%, then we let it be. No need to change. Then exclude those DTA DTLs which are from excluded income. Then apply loss DTA recasting wherever applied. Loss DTA recasting, you know what it is. If even if it is applicable at domestic rate is lower, but you can recast the loss related DTAs. Okay, and record restated balances as opening globe deferred tax position. Clear? This is basically a summary of what we did. Okay, any doubts there? Okay, so no doubts. Let's go forward. Now we'll do an example, and this is the example that we did yesterday. So these things are there. First thing is we'll restate it to 15%. Let's say these are all opening balances. We are restating it to 15%, and that's all we have to do. After restating to 15%, we have to check if there are any uh, any DTA or DTL on excluded income. I don't think this is all excluded income. So let it be. Then there is any DTA loss recast. There is a DTA loss, but it is actually at 30%, and we brought it down to 15%. Now, do we have to do any recasting? No. If the domestic rate was 9%, then we may have to recast this loss to 15%. Are you getting it? Then what is the last one? No. So nil, and that's it. So three, restate it to 15%, exclude DTA, DTL relating to excluded income, and apply DTA lost recasting. Okay. Then we found out that the net globe deferred tax position. So opening balance that would be and for globe related purpose would be 1.2 million. Now I'll ask you a simple question. Would this 1.2 million be there in your P&L? Would that 1.2 million, 1.25 million would be there in your P&L or not? Yes or no? Simple question. Sahil says no, Ashik says no, Reshma says yes. The thing is, this will not be there in P&L, my guys, because these are opening balances. Okay, DTA, DTL opening balances in balance sheet. So to calculate the closing deferred tax balances, this would be used as opening and not the one that is already there in balance sheet. What would be there in the P&L would be like what happening in current year. Okay, this is previous year, all the balances. Okay, thumbs up. Restated opening position becomes the baseline for all future DTA calculations. Movements from this restated baseline, not the accounting baseline, determine DTA in each subsequent year. Okay, very well. So then there is loss DTA recasting and transition. They have just kind of bring. So pre-existing DTAs from losses can be recast upward to 15%. You already know this, regardless of the domestic rate. This is particularly valuable for entities in low tax or zero tax jurisdiction. So let's understand one recasting. This is only for DTAs which are based on losses. So let's say MJ Cayman Limited enters Globe with accumulated losses of 5 million. Okay. So what would be the accounting DTA? It's going to be zero. Globe DTA recast would be 5 million into 15%. So their opening balance would have 750,000 even though their accounting DTA is zero. Okay, the 750,000 DT is available for offset future to offset future globe income, reducing top-up tax exposure from year one. Okay. Now pre-transition DTL treatment. Now we DTLs imported in the transition year are exempt from 5-year recapture. So whatever is the opening balances, right? Opening details completely exempted from the recapture. So this that won't be applicable to them because it's a very logical doubt. No, I have details in my opening position which will not reverse in the next 5 years also. So should I recapture? Answer is no. That is accepted. Only details that is arising from the globe implementation should be used for recapture rule. Clear? This is hard theory. Yes or no? Are you logically agreeing with the proposition that is placed? Because previous I didn't know globe will come, and also now if you're saying that is taken out, then it is harsh, right? So only pre transition DTL will be exempted from the 5-year capture rule. So group do not need to reconstruct the origination dates of pre. So you have to again the not just that, the whole problem is you have to go back and see when it is reversing, whether it is FIFO or LIFO. All that things should have to be done for the opening balances. That's a compliance nightmare. So in order to avoid all that, they do not need to reconstruct origin rates of previous details. They must clearly distinguish transition year imports from post-transition details. You should, but you have to clearly distinguish details which are there already there in the opening balance and those which are created new. That distinguishment should be there. Otherwise, so that we can apply the recapture rule only from those DTLs which are starting from the transition year. Is it clear? Okay. Yeah, you have to distinguish as only the latter trigger recapture obligation. Okay. I see all confused faces, so I'm asking again, like, it could, but couldn't be so easier than this. Is it clear or something bothering you? Okay, let's see. And then, as a part of transitional deferred tax adjustments, there is an anti-abuse exclusion also. So what is meant by anti-abuse exclusion? We'll understand. So certain deferred tax attributes from the opening balance sheet cannot be bought into the globe system if they arose after 30th November 2021. So this is an anti-abuse cutoff date specified in globe transition provisions. Okay, so certain deferred tax attributes can't be brought in if they arose after 30th November 21. Now, what are those DTAs from intra-group asset transfers? Okay, so what happens is if I know that there is going to be a globe, because by 30th November I know that there is going to be a globe. So as to hedge my position, some early birds, what they will do is they will do some intra-group asset transfers. Okay, so DTAs from that would actually inflate their globe DTAs. So let's say there is a company in 30% jurisdiction and there is a company in 10% jurisdiction. Let's say. Now what they will do, the 30% one would take a loss, and the 10% one would get a very big gain on which they will pay taxes, and there would be deferred tax treatment on that. So what happens is the 10% would be inflated to some 15%, hence avoiding the benefit. So that is anti-abuse exclusion. So DTS from intra-group asset transfers. Okay, within related party asset transfers. DTS from government granted tax benefits prevents creation of all artificial DTS through targeted incentives. And DTS on excluded income transactions prevents mismatch. So those things will be excluded. Okay. So those would not be taken as a matter of anti-abuse. So all the related party transactions, okay, arising after 30th November 21 in respect of intra-group asset transfers or government granted tax. What I will do is, okay, Globe is going to come, my low taxed entity is going to be taxed. So I want to protect it. So I will do some government grants. I'll take up some incentives from the government and do a deferred taxation so that my low tax constituent entity is not going to be under 15%. So all those, and to reduce all anti-abuse things, any DTA or DTL that arose after 30th November 21, which would be there in your opening balance sheet, is removed. Okay, in respect of these things. This is clear. So for each DTA in the opening balance, verify the origination date. Okay, if the underlying transaction occurred after 30th November 21, assess whether it falls within the exclusion category. That's how you will find that out practically. Okay, fantastic. So basically, instead of going there, like, I prepared a checklist here. So what all things would you do on the transition phase? First thing, you can unmute and tell me. I don't think anybody is listening. What is the first thing for transitional adjustments relating to deferred taxes? What is the first thing you will do? First thing is you will take all the balances, correct? For each jurisdiction entering globe, inventory all deferred tax balances from opening balance sheet. Take all the deferred tax balances, whether asset or liability, and what is the net figure, either it's a DTL or a DTA, you will take the opening balances, correct? That's done. Now, what is the, once you do that, what is the step you do for transitional provisions? You tell me. Yes. Okay, restate into 15%. Yeah, but before that, classify each item, whether it's a DTA or a DTL, loss related or other, recapture one or non-recapture one. Okay. So, this is something that you have to do, classify and then apply 15% rate cap, retain or restate all balances at over of 15% of domestic rate. Then once you recap everything, then you will do DTA loss recasting, correct? So recast loss or DTA is upward to 15% wherever applicable. Then once you do 15%, then you have to screen for anti-abuse exclusions. Recapture won't happen for all the details on the opening balance sheet. You straight away check for anti-abuse exclusion. Check origination dates of those DTAs or details and see if it is before or after 30th November 2021. Okay. Then confirm whether globe loss election has been made. If so, skip all deferred tax. Globe loss election, I have not taught. It is next chapter. So globe loss election, what it is, we will study in the next chapter. This you forget it out. You will understand this next after next chapter. And document restated opening balances as baseline for all DTA calculations. Is this clear? The transitional deferred tax adjustments, same thing, but a little different. Okay, thumbs ups or like, okay, not okay. Come on, guys, give me a cheer. Fantastic. So if that is very then establish tracking systems that distinguish pre-transition details which require no recapture from post-transition details subject to 5-year recapture. Okay, so that distinguishment you have to create. Don't mix and match everything, otherwise it will be problem. If it is all clear, guys, let's do this question. So let me see. How you do. Basically, what you have to do is this is SA Germany's deferred tax adjustment work paper. You tell me what is a deferred tax adjustment amount. DTA to be included with adjusted cover tax. Go on. And for simplicity's sake, this is opening balance. Okay, this is the balance as there in the P&L. Now you tell me how to find the DTA or what is the DTA. You give me the answer. You can use Excel, calculator, notes, whatever. Yes. Not take this much time, okay? It's simple. Can I do? Can I start? Okay, I'm getting answers. So Sahil says 3.975 thousand is total deferred tax adjustment amount. Okay, this is DTA, right? Okay, I think one answer is enough for me. I'll just start in the interest of time. So let's go step by step. Okay, this I will remove, or I'll just take an Excel. That's enough. That's better. Yep, you can see my screen. Yeah, can I start doing, or you guys are still doing? I think we are times up, guys. So I will do. Just watch. It's okay. Pens down. So while writing the working paper, DTAA calculation for SA Germany GmbH for the year 2025. Heading is a must. Okay. And then you have to write particulars, and it is pounds. So, okay. This is basic. This has to be captured by everybody. Okay. These formattings and all, you have to do that. Okay. So what is the opening balance? What is the deferred tax expense? Not the opening balance. Deferred tax expense. Okay, somebody else is also total deferred tax 1.325. Okay, I see two answers. So I'll just do. So deferred tax expense as per P&L, they have given. How much is it? 1.6 million. Okay, 1000 1.6 million. Okay. So what is the first thing you have to do? You have to see that it is on 30% rate. So don't we have to kind of bring it down to 15%? So first thing that I will do is less rate change adjust. So so there is all this is in 30%, 38, so 1.6 million. So rate change adjustment for uh, expense. So we will bring that to. So I practically have to do divided by 2. Why you understood why I'm doing divided by 2? Because 30% and 15%. Okay. Now DTL on tangible intangibles. There is a deferred tax liability on intangibles. What do you do? One second. See, this is the total amount, right? So let me add the total. 9 plus 4 is 1.1 million. 1.1 9 plus 900 plus 400 plus minus 250 plus 150 minus 880 plus 50. So totally I'm getting 1170 only. For some reason the total of all this is 1170, not 1.6. Okay. So what I will do is I will go by step basis. Okay. So since the total is not correct, I'll not kind of like take the whole by 2 of here. Let's go step by step. So DTL on intangible assets. Do I have to reduce it down? Yes. So DTL on intangible assets, I am reducing. How much am I reducing? 900 it is. So 450 I am reducing. So it is DTL. So this is a deferred tax expense. So I am reducing. Okay. Now DTL on PP&E is 400,000. So DTL on PP&E is 400,000. So I am reducing 200,000 as rate change. DTA on provisions. Okay, this is DTA on provisions is 250,000. So DTA on provisions. So in order to kind of like bring it down, what should I do? I would have to add it, right? So I'm adding 125,000. Did you understand why I'm doing that? Now, valuation allowance movement. Now, what is this valuation allowance movement? It is an excluded thing. So I am excluding it completely. Should I calculate 15% reduction for that since I am excluding it completely? So I will exclude it, right? You understood valuation movements. So valuation allowance movement, I am excluding it completely. So minus 150,000. I will not do a rate change and all and waste time for this. Rate change impact. It is a DTA. What is this? This is also an exclusion. You remember, any rate changes is an exclusion. So this also I will be impact is negative 80,000. To adjust it, I will do plus 80,000. Okay. Now, DT on excluded dividend. What should I do? What should I do? Excluded dividend is an excluded income. So it is 50,000. So I will do minus 50,000. I excluded from the DD. Okay. Even if it is 30,000%, I don't care. My point is I only kind of reverse these things. So what would be the adjustment amount? From this, I would have to adjust this. And from this, I would have to. So my DTAA. Now before that, you have to check if there are any losses. DTA, which has, anyways, we are restating it to 15%. So there is no recast upward here. So you can ignore DTA loss recasting and all. Recapture rules, they're not given any details whether 5 years have existed or not. So ignore that. So exclusions and deferred tax of, sorry, date thing. So DTA would be what? It would be 1.6 million plus this plus this. DTA would be 955. Is it clear? Simple. Did you understand? Huh? Okay. So this is going to be the DTAA calculation. So again, as a reminder of things like, rate cap adjustments, loss DTA recast upward, very important. Mandatory exclusions, excluded income valuation allowance, uncertain tax positions, tax credits, and tax rate changes. Then you have to recapture DTLs if not reversed within 5 years. You can use either FIFO or LIFO, FIFO only on conditions. Certain DTLs are not applicable for recapture. Okay, even if it is for the current year, and of course all opening transition details are not to be recaptured. Transitional provisions, what you have to do, you have to first restate to 15% opening balances. Then you have to do loss DTA recast, right, upward. Then what do you do? Then there are these things are exempted from recapture rule. Then these are exempted from recapture rule, and then you have anti-abuse provisions. I think that's it, right? So this is what you have to do on transitional provisions, and this is what is how you compute DTA. If it's clear, let's close here. I'll give you the summary of this table also. This was very helpful for revision if you understood everything very correctly. Only if you don't understand something, you have to go and check this. Okay, let's pause then. Tomorrow we have that thing which I told you will be discussed, and that is globe law selection. We'll take that tomorrow if time permits. Okay. So see you guys. Thank you so much.